Middle Market Growth Conversations, a podcast for dealmakers discussing the trends shaping the middle market. I'm your host, Carolyn Vallejo, and this is a production of the Association for Corporate Growth. Today, we continue our coverage of the One Big Beautiful Bill and its impact on private equity with Donald Rawe and Howard Wagner of Forvis Mazars, who join us to dive into the tax implications of the legislation. Donald and Howard, welcome to the podcast.
Thank you.
Thanks.
As always, we're going to get to know you each a little bit first before we dive into the interview. So let's take a few moments to talk about your professional background. Donald, can you tell us about your role at Forvis Mazars first?
Sure, thanks. And thanks again for having us. I've started the predecessors to Forvis Mazars back in 2008 and with Big Four firm before that. And, big picture, I've been in private equity both in the Big Four and at Forvis Mazars since I started straight out of college. It's all I've ever done. And so that's been both tax compliance and then tax structuring and assistance with deals, but not actually in diligence.
And Howard, how about you?
I've recently joined Forvis Mazars. Prior to that, I led the Washington National Tax Office for another national firm. Within our national tax office, I'm focusing on Subchapter C M&A transactional items, as well as the domestic aspects of the One Big Beautiful Bill.
We also like to ask our guests at the top what your first job was and whether there was any lesson you took away from it. So, Donald, let's start with you again. What was your first job?
Wow. This is long ago. I think I was the cart pusher at Target, where I'd have to collect all the carts out in the parking lot. And I think the lesson I take away from it can both be sarcastic and real at the same time, I think. So have a little fun of, I learned what I didn't want to do. And that pushed me harder to excel at college and work hard to get out of college and into a professional career.
Mm-hmm. So. Yeah, that's a great point. Howard, how about you? What was your first job?
My first job, if you don't count a paper route, was I worked at Marco's Pizza in Toledo, Ohio, and delivered pizza until there was a unfortunate incident in a snowstorm involving my mother's 1981 Dodge Colt, and that was the end of my pizza delivery career.
Any lessons that you took away from that experience?
You don't want to be a pizza delivery guy.
Don't slam on your brakes in the snow, Howard.
That too, yeah. You didn't want to be a pizza delivery guy for the rest of my life.
You know, it's a fair point to say these jobs gave you each an experience of learning what you don't want to do to move forward. I think that's fair to say. All right, let's dive into the interview. So turning to the One Big Beautiful Bill, there is a lot to unpack from the legislation, particularly in terms of the tax implications for private equity. So let's go through some of its provisions one by one, starting with interest limitations. Donald, can you kick us off and talk about that for a minute?
Thanks, Carolyn. Yeah, absolutely. I think, interest is a big component of private equity in the sense that through leverage, they're allowed to do bigger and better things than if it was just pure equity. So interest limitations that came in with the original TCJA Act in 17 that was effective for 18 gave us a limit on domestic deduction of interest we hadn't seen before. And originally it was limited to EBITDA, tax basis EBITDA, a percentage of tax basis EBITDA. And so you'd start with taxable income and back into a tax version of EBITDA. And then in 2022, it went down to 30% of tax EBIT, which started to really eat into those that need a lot of leverage, but then also those with a lot of, CapEx. So think heavy equipment or equipment heavy businesses where they have a lot of depreciation expense that really bites into their ability to deduct interest. And often that equipment's expensive, so you borrow to acquire it. So long story short, there is in 22, 3, and 4, we saw a lot of our clients, especially in private equity, get squeezed a bit on how much interest they could deduct. So they were becoming taxable even though they were spending all this money on interest. With the OBBBA, we see that it's a return to 30% of tax EBITDA. So this kind of levels the playing field for those businesses that have a significant amount of depreciation expense or amortization expense compared to those who don't have that. And it becomes a true almost cash flow measure again, which is, the underlying idea of EBITDA. But Howard, did you have anything in there to add that I left out?
Yeah, I think the only thing I would add there is for owners of flow-through businesses, especially partnerships, there's a lot of complexity to the 163J calculation and how you use Section 163J carry forwards. There was potentially an opportunity for them to clean some of that up in this recent legislation, but they didn't do it. So a lot of the complexity for pass-through entities is still there. Pass-through entities being partnerships, primarily S corps, are a little cleaner in this situation.
Got it. Let's now turn to bonus depreciation and the taxpayer opportunities here. Howard, could you kick us off here?
Sure. We've had a lot of variations in bonus depreciation over the years. It came, it went away, it came again. And in TCGA, it came, but it was temporary. It was 100% for a while, and then it started phasing down on a schedule until it was eventually going to phase out. Absent any action by Congress, it would have been 40% for 2025, with some further phase outs down to zero. There's probably less of a policy reason for why they did that and more of just some of the fiscal engineering you have to do for tax reconciliation and getting things passed. What they did in OBBB, one big beautiful bill, is they returned us to 100% bonus depreciation. And unlike prior versions of bonus depreciation, which were temporary and scheduled to expire, this is permanent. So it's going to be around forever. You can plan on it, you can rely on it. So if you're buying new property and equipment, non-buildings, you can take 100% bonus depreciation in this year and get your deduction for it. One thing you need to be mindful of is there's something known as a binding contract rule. What that says is, in essence, the incentive is only for businesses that invest in property after the effective date of it, which in this case is the effective date of Trump's inauguration. If you had what's known as a binding contract rule, as a binding contract to purchase property prior to that effective date, and you place it in service after, it's still only eligible for the 40% bonus depreciation, not the full 100% bonus depreciation. So one of the things we're working with our clients on is looking at those additions, earlier in the tax year and trying to make sure that you didn't have a binding contract to acquire them prior to the effective date of the legislation. The other thing that comes into play here is if you're acquiring a business in an asset deal, a taxable asset purchase, you'll be able to take generally the 100% bonus depreciation on the qualifying assets and jumpstart some of your deductions right off the bat. One of the new things added by OBBB is bonus depreciation for manufacturing buildings. It's technically described as something that is non-residential real property for qualified production property. If you build a building and if you're doing qualifying manufacturing in the building, you can write off 100% of the building's costs instead of depreciating it over 39 years. It applies if construction started after January 19th of this year and before January 1, 2029, and you place it in service by January 1 of 2031. So if you're building a new building to do manufacturing in, the portion of the building that would normally be depreciable over 39 years is going to be deductible immediately. The reason I say the portion is you're only allowed to take it on the manufacturing portion of the building. So if you've got office space or research space or sales folks that are operating out of the building, that part of the building doesn't count. It's only the part of the building used for manufacturing. Be careful with the definition of manufacturing. It's a very specific definition that looks to how much transformation you're doing on the property. If you're just taking stuff out of multiple boxes, putting them together in a new box and sending it out, that's likely not going to be manufacturing. But if you can meet the effective dates for this can be a powerful immediate tax deduction. There are a few traps to be careful of here, namely if you take this deduction up front and you cease to be engaged in the right manufacturing activities in the facility, you have to recapture the deduction if that happens within 10 years. So that's just something to be aware of, but all in all, it's an exciting new opportunity.
And Howard, it's kind of funny. I don't know if you remember when 168K, which is the definition of bonus depreciation, came in. Do you remember the year abouts that came in or why it came in?
I can't remember if it first came in the Great Recession or if it came in before then and then came back in the Great Recession.
No, it's the 2000. It was a dot-com burst.
Right. And then it came back in the Great Recession.
That's right.
And then it came back in TCJA.
And now it's here to stay.
It's here to stay.
Here at the Middle Market Growth Conversations podcast, we host in-depth conversations with experts in middle market M&A and corporate growth. Whether we're learning about how deals get done, the shifting economy, opportunities in specific sectors, or the growth strategies our guests are prioritizing, we're discovering more about the middle market and the trends shaping it. If you want more thought leadership in this vein, visit us at middlemarketgrowth.org for in-depth sector reports, articles, videos, and more. If you want in-person networking opportunities with other mid-market dealmakers and corporate growth professionals, visit acg.org to learn more about Association for Corporate Growth membership, as well as upcoming events. Now, back to the episode.
Donald, there is also a provision in the bill that impacts flow-through businesses. What changes here should PE firms be made aware of?
Yeah, I think the thing here is, right, pass-through or flow-through, just remembering there's a little bit of everything in there, just the way folks refer to them. But we were looking at hopefully seeing a 23% flow-through deduction instead of 20%. It never did happen, but the best part of it is the flow-through deduction is now permanent, as it was part of the TICJA Act. It's now permanent, so we're very excited about that. One of the things that is indirectly but directly related to that, I know tax is always direct and indirect, I feel like, is 461, but I know that 461 is a passion project for Howard. Howard, do you have anything to add to 461 discussion?
Are you trying to trigger me? Section 461L is something that came in TCJA that puts an overall limit on how much you can deduct from trader businesses in a year. So, for example, if Don and I put $10 million each into a new business, and that was the only business that we invested in, so 20 million went into the business. They give each of us a deduction for $5 million. On our tax returns this year, we can take a deduction, each take 600,000, and the remaining 4.4 out of the 5 million is carried forward as an NOL available in the next year. And once you convert it to an NOL under the current rules, it's subject to a 80% limitation in terms of how much you can use to offset taxable income in the current year. This really causes problems for folks who are expecting to see big deductions for their capital investments that give them deductions. The other thing that comes into play is upon exiting from the business, sometimes there's traps in here that can cause you to recognize the gain from the sale of the business in the year of the sale. But when you free up suspended losses or other carry forwards, those might get trapped by this limitation and not deductible until the next year, to where you get a mismatch of the income in one year and not being able to use all of the losses.
Donald, did you have anything to add there?
No, I think it's a great summary. And yeah, we're just excited that it's permanent. So now we can plan for more than just a year in advance.
Yeah. What about the pass-through entity tax, Howard?
Yeah, so a little background on this. It used to be, prior to TCJA, that everybody got unlimited deductions for state and local income taxes. You might have some drag on the deduction because of alternative minimum tax, but everybody got the unlimited state and local tax deduction. In TCJA, two things happened. They took away state and local income tax deductions, capped them at $10,000 for itemized deductions, and also lowered everybody's income tax rate. Depending on which side of the fence you're on, some people are, a lot of people are upset that, you used to get these very significant deductions, especially if you're a business owner with a pass-through entity making a lot of money. You lose the deduction, and everybody's very upset about that. What the proponents of TCJA would tell you is, you lost the deduction, your rate went down, you're still coming out ahead. But needless to say, the state and local tax deduction has generated quite a bit of controversy for anybody following how the legislation went this year. When the $10,000 cap came about on state and local taxes, states got creative. They came up with regimes where you basically said, instead of this partnership or S Corp passing out all of its income to its shareholders, and the shareholders pay tax on their individual returns and get their deduction for that income capped at $10,000, they got creative and came up with tax regimes that said the pass-through entity, the partnership or the S corp, can elect to pay tax at the corporate level. It's deductible as a business expense by the partnership, and it never hits itemized deductions of the individual. What it effectively does is gets you around the itemized deduction limitation for income from your pass-through entity. If you're making money, this is obviously the way to go because it gets you a deduction you wouldn't otherwise get. The one thing you do want to be cautious of is if you go from losing money to making money. Say Don and I start that business and it's a startup, and ignoring all of the other limitations, we lose some money in the first couple of years, we have net operating losses, and in year 3 we make money. Before you just jump and automatically assume that you want to start paying taxes at the corporate level to get the deduction, in a lot of states, the individuals have a net operating loss deduction that they can use to offset their income. If you go to this elective tax regime, you might not get that net operating loss and might write a check for something that you don't need to write a check for because of the individual NOL. So as you transition to profitability, just keep an eye on that and understand how you can use your state losses along the way.
And I think that's pretty important, right? A lot of our private equity portfolio companies that start out, that first year is usually a loss. Entering profitability in the second or third year is usually the goal, especially now that we have limitations on interest and other items. So it's a great planning point there, Howard. And then on the flow-through deduction, backing up to the flow-through deduction, only certain businesses qualify for that. And then where you pay the pass-through entity tax in the structure matters. It may not be at the lowest tier. You may have to pay it at a tier that's much higher up. So providing regular quarterly information to the investors is important so they can start to project when they're going to run out of, say, that cumulative loss that they've accrued in the state, or whether they need it paid sooner.
Donald, there are also provisions impacting research and development expenditures. What are the key impacts there?
Well, the good news is, and this is my favorite change in the law, at least that I've seen so far, is it sure got a whole lot easier, and we have a lot less hard conversations to have with our clients. So there's no change on the foreign research and development costs. Those are still capitalized and amortized over 15 years, which is something that came in with TICJA, but was a slow burn for when it actually got implemented. Beginning in 2025, though, we no longer have to capitalize those for domestic purposes. So any domestic R&D that's done, we can go back to deducting those concurrently on the return, which is a great benefit from the standpoint of you'd either have to capitalize them and deduct them over 60 months, something that used to be deductible up front. That was really hard for some clients who have a large R&D spend, and it was mismatching, the cash again is out the door, similar to interest, but the deduction can't be had, so you end up artificially paying tax sooner than you otherwise would have to, which can strain the business. But starting in 2025, we can now deduct those. Great. We can still do the R&D credit. Great. And for any of those capitalized costs where we began to capitalize them in 22, 3, and 4, those can be deducted all in the first year, or you can spread it out over 2. And I think it's going to be a really good windfall, if you will, for our clients to get those tax dollars back and get that deduction up from the artificially increased incomes they've seen from the past couple of years.
Yeah, I mean, in essence, they're giving you a refund of everything you capitalized in 22 through 24.
That's right. And so, one of the harder things that we don't know, and, Treasury will probably answer this by the time we have to file extensions, we're hoping for the 25 year, is when that 174 capitalized cost reverses. What is that? Is that amortization expense, or is that ordinary income? And it can impact interest limitation deductions and all that. So that's one thing, we have high on our radar of what to expect. We don't have a final answer, but, Howard, do you want to add any commentary around that?
No, I mean, I think the good news is everybody's going back to at least the way we used to be on domestic R&E.
Yeah.
I think the practical aspect here is you had a lot of startup businesses that were spending heavily on R&E, maybe only had a nominal amount of revenue, and they were being forced to be taxpayers. And that just wasn't what everybody intended from a policy standpoint. I think what's interesting is, the mechanics of how you get those refunds. Everybody has the option to either, deduct everything that's on their books at 12/31/24. Let's say you've got $2 million of capitalized R&E costs sitting on your books at 12/31/24. You can take a deduction for them in 2025. You can take a deduction $1 million in 25, $1 million in 26, Or if you're a qualified small business, you can go back and file amended returns to get those. That has proven to be maybe more complicated than everybody set out to be because of some of the interesting rules that apply to partnerships.
Oh, and I got one, and 461L.
Yeah. I mean, that goes into the question of how do you decide if you're going to take the deduction over 2 years or take it over 1 year. So I think, for businesses of all sizes, before you just say, hey, I'm going to deduct it all this year, there's a lot of modeling and things to consider so you can make the right decision, because it's counterintuitive, but there will be situations where taking it over 2 years might give you a better tax answer than taking it over one.
Yeah, I could see that definitely in a flow through scenario versus corporate, right? Not quite as punitive, but could on the 80% NOL limitation.
Yeah.
Mm-hmm. Well, finally, let's turn our attention to 1202 changes and its impact on investors. Howard, I know this is a big one.
This one's huge. This is one of the biggest benefits out there. Section 1202, I think a lot of the ACG listeners are probably going to be savvy on this, but if you're an individual, a non-corporate taxpayer, you make an investment in a C Corp, you acquire the stock at original issuance, it meets a gross assets test, which used to be $50 million. It's in an active trader business and something that's not professional services or something like that. The old rule was if the company has less than $50 million in assets, you acquire the stock at original issue. It meets all the other tests. Once you got to 5 years, you could exclude the greater of 10 times your basis or $10 million. So if your basis in the stock was, 500,000, you could exclude up to $10 million. If your basis in the stock was $12 million, you could exclude up to $120 million. Just a huge, powerful benefit here. One of the downsides, though, was you had to get to 5 years. It was all or nothing. They made 3 changes in OBBB with respect to 1202. The first one raised the asset threshold. Instead of the company having assets of $50 million at the time you bought the stock, it was extended to companies with $75 million in assets. Be careful when you're measuring assets. It's tax basis and assets, not book basis. And you have to make certain adjustments to go from basis to fair market value of assets when you do certain corporate transactions. So you really have to dig in and look at the balance sheet and what it looks like on the day you invest. But the key takeaway is the threshold is going from $50 million to $75 million. The second piece of this is the example I gave where it was 10x or 10x basis or $10 million, 500,000, I could exclude up to 10 million. That's now been changed to 10x basis or 15 million. So somebody whose basis was 500,000 on something that's a home run can now exclude up to $15 million of gain. The third change that was made is the holding period. And this is for new stock issued after July 4th, the day they actually signed the bill. Used to be 5 years, all or nothing. And Don, I know we've had a lot of conversations over the years with clients who 3.5 years in, they're very focused on 1202. Either the offer of a lifetime that'll never be replicated shows up at their door, or they may have some insights on their business and the model that they're in and realize that their valuation will never be higher. 2 years from now, when you're finally eligible for 1202, changes in the world that you expect might mean your company won't be worth as much then. Some really tough decisions for companies as they were trying to decide whether to sell or not to sell if they were focused on 1202 benefits. The big change in OBBB is a 3-year phased-in exception. You get a 50% exception if you hold it for 3 years. You get a 75% exception if you hold it for 4 years. And then you get the full exclusion if you hold it for 5 years. Once you get to 5 years, you've got the full exclusion. Anything in excess of the exclusion is taxed at 20%. There's a quirk in how the gain is taxed for prior to the 5-year period. For the new stock, it's taxed at a 14% rate. So when you get the 50% exclusion, you're paying 14% in year 3 instead of 20%. When you get the 75% exclusion in year 4, you're paying 7% rather than 20%. But again, it gives a lot of flexibility to investors to still monetize some of their 1202 benefits if they think the right time to sell is prior to year 5.
And Howard, one of the best things we see in private equity, back to your comment on who our listeners probably are here, is we own that stock of the C Corp, which is one of the requirements in a partnership. And there may be tiers of partnerships, but when that comes all the way out, each person, that $10 million, which is now $15 million maximum, that's measured individually, right?
It's measured with respect to each partner, each individual.
Right. So on each 1040, that's measured. So if you think about this, it's way more than 10 or 15 million when looking at just a company to the example you had. It could be far more gain could be excluded. It could be 100% of gain on $1 billion sale if it's spread out amongst enough people. So it's insanely powerful when it goes all the way out and you see how much hits each person's return. So.
And for a business owner with children and grandchildren, there's techniques where you can gift stock and have everybody count for the 10x or 15 or 10x or $10 million on each kid and grandchild's return as well. Just a host of planning opportunities.
Right. Yeah. So I gave the private equity and you're in the family wealth strategy spectrum there. And
I might refer to it as founder rather than family strategy, but yeah, it's more, that's where I was going with it. The thing that's often overlooked in 1202 is very focused on by, the founder of the business and how they exit. And in a lot of cases, the private investors or the private equity company and how they exit. What's often overlooked is employees. If I get stock in the company as compensation, Don thinks I'm doing a great job, and to get me to sign on to the company, when I come, Don's going to give me 500 shares of common stock. And guess what? If on the day I acquire the common stock, as an employee, the company is under 50 million or under 75 million and meets all the tests, I can also qualify for the 1202 exclusion. So don't just think of it for your founder and your investors. In certain situations, your employees can benefit from it as well. There are stories out there still today of people who were early Facebook investors, early Facebook employees cashing out in 1202 benefits.
Wow. Okay. So a lot to be aware of, a lot of tax changes for private equity, but also it sounds like some certainty built into OBBB for investors. So Donald Rawe and Howard Wagner from Forvis Mazars, thank you both so much for joining the Conversations podcast.
Thank you very much.
Thank
you. Thank you for listening to this episode of Middle Market Growth Conversations. If you haven't yet, please subscribe to the podcast on Apple Podcasts, Spotify, or wherever you listen to podcasts. This podcast is produced by the Association for Corporate Growth. Learn more about us and discover new opportunities to network with middle market dealmakers at acg.org. For more thought leadership from dealmakers, business leaders, and other experts, visit middlemarketgrowth.org. If you like what you've heard today, please rate and review the podcast. And finally, if there's a topic or guest you'd like to hear on the podcast, or if you have any other feedback you'd like to share, send a note to us at tips@acg.org. Thanks again for listening.